Hello, everybody. Good evening. I'm David Victor, President of American Educational Institutes. Thank you for joining us tonight. We have a nice group of folks. I think we had over 200 people registered for this webinar. I don't know how many are on right now, but I think you're in for a treat. As you saw from the email, today's presentation, this is only our second webinar, by the way. Most of you, virtually all of you, have taken our courses before, so we're no strangers to producing continuing education content. But these webinars are a relatively new thing. This is our second. Our first one was very well received, so we thought we'd keep going, particularly since we have some important topics of late, of which most of you are quite familiar, more familiar than you want to be, particularly as pertains to tonight's lecture. So tonight we have Ms. Carole Foos, who's a CPA. She is a partner with the OJM Group. That may sound familiar to a number of you. David Mandel, who many of you have seen over the last half dozen years or so, is also a partner of OJM Group. He typically speaks about asset protection and certain corporate structure planning on our program. Carole has been a CPA for 25 years now, all of which she's dealt with physicians, the last 13 of which she has dealt exclusively with physicians as a partner with OJM Group. And OJM Group, by the way, and Carole can get into this in a bit more detail. OJM Group deals with exclusively, by the way, a physician clientele, and it deals with a full range of asset protection, asset management, and financial planning services. Carole will tell you a little bit more. Carole's talk today concerns the PPP loan. Now that you have it, how do you convert the loan into effectively a grant? How do you make sure that that loan's forgiven? And there is art, or rather really science to this, and Carole's going to lay that out chapter and verse. So I think without further ado, we'll turn it over to Carole. Carole will speak for roughly 30 minutes, and we'll go to Q&A. Now, with respect to Q&A, you'll see on the right-hand side of your screen a question and answer section. You simply type your question at the bottom of that section, the bottom right of your screen, but be sure to hit the send word, the blue send word. Or just hitting return on your keyboard will not get the question to us. We will know no one else will see your questions but me, and I will know who's asking the question. So ask your question anytime you want, hit send, and then Carole will address as many questions as time will allow, and in all likelihood, address those that you couldn't get to during this presentation offline. Okay, enough from me. Let's turn it over to our talent, to Carole Foos. Carole, go ahead.
Thanks, David. Appreciate it. And welcome, everyone. Thanks for joining us this evening. I hope everybody had a great weekend, and I hope that you're going to find some useful information in our webinar this evening. As David mentioned, my name is Carole Foos. I'm a CPA and a partner at OJM Group. I work in our Cincinnati office. We are a multidisciplinary financial planning firm. So we do asset protection, retirement planning, tax planning, benefit planning, insurance. Most of our clients are physicians. We do have some non-physician clients, but probably 85 to 90% of our clients are physicians across the country. I do want to mention too, we've written a number of books specifically for physicians, including a CME piece. And we do want to offer any of the viewers this evening one of our books for free. You can get a free book by texting AEI OJM to the number 555-888, and you'll get a reply. Click the link. We'll get your contact information. We'll send you out an ebook if you want, or you can visit our bookstore online on our website at ojmbookstore.com. Enter that same code AEI OJM when you're checking out, and you'll get the book for free. So I did want to mention that. But more importantly, we're here tonight to talk about the Paycheck Protection Program Forgivable Loans. I'm sure many of you who are on this evening received a PPP loan for your practice. I hope you did. I hope you were able to take advantage of some of the funds that were made available. I'm guessing many of you are well into your coverage period and trying to spend the proceeds appropriately for those loans. So what I'd like to do tonight, as I'm also sure you're aware, the guidance on these has been relatively constantly changing. You know, the law was passed on March 27th as part of the CARES Act. The SBA is in charge of this loan, although you applied through your local bank or a local bank. SBA has put out quite a bit of guidance on the loans. A new law was passed earlier in June, the PPP Flexibility Act, which came out with some new rules. SBA came out with some new guidance. So we're going to try to cover as much of that as we can this evening and get you ready to make sure you're maximizing your loan forgiveness. So let's talk first about the loan itself and when you received the loan. When the loan was applied for, the maximum amount of the loan that you could take out was based on your average monthly payroll that you had over the past year. And a few banks did it differently. Some did the previous 12 months, some did calendar year 2019, but it was over some 12-month period. You calculated your average payroll, you multiplied that number by 2.5. So essentially your loan could be 2.5 months of your average monthly payroll, or $10 million, whichever was less. Now, keep in mind that when the CARES Act passed March 27th, the PPP funds opened up pretty shortly after that in early April. There was not a lot of clear guidance on what constituted payroll costs. So you may have had a different understanding of what you could include as a payroll cost when you applied for the loan versus what's come out now in their guidance, particularly as it relates to compensation for owners. So we're going to talk about that. They did make clear in the law and in the initial guidance that any individual employee who earns more than $100,000 per year would be limited to an annual salary of $100,000. So again, when you were applying for the loan, you'd cut off any employee at $100,000 and you'd take their monthly portion of that times 2.5 months. You know, that would be the loan for that particular, that particular employee's payroll. The limits, as I mentioned, are different for non-owner employees versus owner employees. So that's important to note. Also important to note, when the loans came out, there was a lot of talk and a lot of press about the good faith certification. You needed to certify on the loan application that your business needed the loan in order to continue to fund operations due to the uncertainty of the COVID-19 pandemic. Then we saw a lot in the press about businesses that receive loans, places like Shake Shack that got loans that by the letter of the law, they were eligible, but it was really frowned upon. They had public funds available, public company. So then they talked about lots of audits of whether you really met the good faith certification. They have come out with a safe harbor on the good faith certification. So if your loan amount was less than $2 million, you will be presumed to have met that good faith certification, and you will not be subject to any criminal or civil penalties. The SBA has said they will audit all loans that are over $2 million, and they will audit some of the loans that are under $2 million. So my recommendation to you is, even though if your loan was under $2 million, you're not going to be subject to any penalties related to the good faith certification. We don't want that to affect your forgiveness. So what I would recommend you do is maintain a file of how your revenue dropped due to the pandemic. If your practice was shut down, or if your practice, you weren't allowed to do non-emergency procedures, if elective procedures weren't allowed, and so your practice was greatly minimized, keep a record of that, keep it in the file. If you've got comparisons of your revenue from 2020 compared to 2019 that shows revenue was lower, comparisons to what you budgeted, if you had discussions with your partners or with your attorney or CPA about the possibility of furloughing staff or reducing their hours, and then you didn't have to do that because you received the loan, note that in your file. Just keep the file so that you've got that backup. In terms of what are the allowable uses of the loans, payroll costs, are what they want most of the loan to be used for. The law now saying 60% of the loan needs to be used for payroll costs. That payroll includes any salary, wages, commissions, bonuses paid to employees, vacation and sick leave paid to employees. It also includes group health benefits that the company pays and retirement benefits that the company pays for employees, but not for owners. And we're going to talk about that again in a few minutes, but you can add to your employees' wages. You can also add those health benefits and retirement benefits that you are paying for, but not for yourself. Mortgage interest is an allowable use of the loan. Rent and lease payments for both real and personal property can be used with the loan proceeds, and utilities. Utilities will include electric, gas, water, phone, and internet. So those costs that are incurred within the coverage period are going to be an eligible use of the loan for which you can apply for forgiveness. Now, keep in mind, these loans are non-recourse. They did not require a personal guarantee. They did not require any collateral. The maturity of the loan is partially going to depend on when you received the loan. If you received the loan prior to June 5th, then your maturity date, the term of the loan, is probably a 2-year term. When the PPP Flexibility Act was passed, they extended that maturity date out to a 5-year term. You do have the ability, if you received your loan prior to June 5th and you have a 2-year, your loan document says it's due within 2 years, you and your lender can mutually agree to extend that loan out to a 5-year period. So if you think that's something you want to do, if all of your costs aren't going to be forgiven, you might want to be talking to the bank where you got the loan about extending the period out to 5 years. The loans have a 1% interest rate. There is a deferment period. Originally, they had said the deferment would be for 6 months, no principal or interest payments for a 6-month period. They have now said, after the PPP Flexibility Act was passed, that they're actually going to defer interest and principal payments until you have applied for forgiveness and that forgiveness application has been processed. So your deferral period could be more than 6 months now. When we're talking about allowable payroll costs, I want to talk to you about what's allowable for non-owner employees, okay? It's the cash compensation that I mentioned. It can include a bonus to an employee. It can include vacation and sick leave. It is limited to that $100,000 annual rate per employee. You've got 2 choices. Again, if you received your loan prior to June 5th, you can choose your coverage period. So the amount of time that you've got to spend the money, you can either have an 8-week period or a 24-week period. Now, those coverage periods begin, either the 8 weeks or the 24 weeks, will normally begin on the date you received the loan. So if you received your loan on May 5th, your 8-week period begins May 5th, or your 24-week period begins May 5th. You were also allowed to choose if your payroll is run bi-weekly or more often. You can choose what they're calling an alternate payroll period as the start date for your coverage period. So I want to give that example again. If I got my loan on May 5th and I run payroll every 2 weeks, and my next payroll date was May 11th, then I can choose to have my coverage period begin on May 11th, and that's when that 8-week or 24-week clock will start ticking. If you choose an 8-week period, for any non-owner employee, the maximum amount of compensation you can include for the loan forgiveness for that one employee is $15,385. If you choose the 24-week period, that amount goes up to $46,154. We're also talking about employees who are U.S. residents only, okay? You can include employee benefits for these non-owner employees. So as I mentioned, those employer contributions for employee health insurance, even if your practice is self-insured, you can include that self-insurance cost, as well as employer contributions to employee retirement plans. Now, those benefits, those employer paid health insurance and retirement contributions for a single employee can take those amounts above the 15,385 or the 46,154. So that 15,385 and the 46,154 are cash compensation. You can add to that health insurance and retirement benefits. For owner employees, again, this has kind of been ever changing from the time they passed the law, but current guidance says an owner employee is an S corporation owner who receives W-2 wages. It's anyone who is self-employed. It's an independent contractor, or it is a partner in a partnership. For those individuals, compensation is limited to one of two numbers. So if you've chosen, or if you are choosing the 24-week coverage period, the maximum amount you can include for your compensation as an owner will be $20,833 or 2.5 months of your 2019 compensation. So if you paid yourself less than $100,000 in 2019, you're not going to be able to include the entire $20,833. It's going to be what your 2019 compensation was, divided by 12 times 2.5. If you choose the 8-week period, your maximum compensation as an owner employee that you can claim is $15,385, or your 2019 compensation divided by 52 weeks times 8. So again, if your compensation that you took out of the business was less than $100,000 in 2019, you're not going to get that whole $15,385. You can also add, for both owners and employees, any state and local taxes that are assessed based on compensation. So think about state unemployment taxes, state workers' comp. You can add those costs in. This is important to note. We're talking about payroll costs paid and incurred during the coverage period. So for that 8-week or that 24-week period, any paychecks you distributed or ACHs that were initiated for payroll, those will be included. So if my coverage period, started May 5th and I paid payroll on May 15th, May 31st, June 15th, all of those payrolls will be included. If my next coverage period is, June 30th or it's July 1st and my 8-week period ends just before that, I'm going to be able to include the payroll that is incurred. So for those 10 days or whatever number of days it might be till the end of the coverage period, I can count that payroll as long as it's paid on the next scheduled payroll date. So if my next payroll falls just a few days after that coverage period ends, I'm going to be able to include most of that payroll, right, the pro rata amount, in as a cost that can be forgiven. Important to note, non-payroll costs also have that paid or incurred rule. So any, mortgage interest, rent, utilities that you pay during the coverage period will be allowed. If they're incurred during the coverage period, so for instance, if I've got a utility bill that is for the month of June and my coverage period ends June 30th, but that bill is not due until July 5th, I will still be able to include that, electric bill, gas bill, whatever it might be, as one of my forgivable costs. You cannot prepay mortgage interest and have that count. And we're going to talk about, the non-payroll costs can't be greater than 40% of the forgiveness amount. So kind of simple math. If I got a $100,000 PPP loan, I need to spend 60% of that on payroll. So if I spent $60,000 on payroll, then I can spend $40,000 on the non-payroll costs, mortgage, interest, rent, utilities. If I didn't spend $60,000 on payroll, if I only spent $50,000 on payroll, then I have to take, that $50,000 and I'm going to lose some of my forgiveness. So I would actually take 50,000 divided by 60%, whatever that number is, times 40% will be the amount of non-payroll costs I can exclude. These are all in the forgiveness application. So just note that 60% on payroll, at most 40% on non-payroll. Okay. And if you didn't spend the full 60% on payroll, there will be some reductions. When we're talking about mortgage interest, it's on real and personal property as long as that mortgage obligation existed prior to February 15th of 2020. Rent or lease payments also for both real and personal property as long as the lease was in effect before February 15th, 2020. Utility payments, as I mentioned, electric, gas, water, phone, internet, transportation, the service had to have begun before February 15th, 2020. So you can't have gone out and said, oh, I can include my cell phone bill, as an allowable cost. I went out and got cell phone service on March 1st. That's not going to work, right? I'm sure all of you already have cell phone service. It's an includable business expense. And again, paid and incurred, that's important for both of these types of costs. So there are some situations where the full amount of the costs or the full amount of the loan proceeds won't be forgiven. And when that happens is if you had to reduce your full-time equivalent employees and that headcount reduction is not made back up, so they're not rehired by December 31st of 2020, then you will likely have a reduction in your forgiveness amount. You're also going to have a reduction in the forgiveness amount if any one employee's salary was reduced by more than 25% during the covered period, so during that 8-week period or the 24-week period, compared to the most recent quarter. Okay, so if my covered period starts sometime in April or May, I'm going to look back to the first quarter of 2020 and make sure that I didn't reduce any employee's salary by greater than 25%. And if I did, I don't have to look at those employees that are making more than 100,000. So they're really trying this, to be not cutting employees or reducing their pay for the employees making less than $100,000. As I mentioned, if you rehire the employees or if their hours go back up to normal hours by December 31st, there won't be a reduction. If you offered employment back to an employee that you furloughed, for instance, if you have a written offer at the same pay rate and that employee refuses it, then you're not going to have a reduction for that employee. You kind of have an exemption for them. So make sure you're documenting that as well. Okay. The forgivable costs that we're looking at, if I'm considering my full-time equivalent employee headcount, I'm going to take my average full-time equivalent employees per month during that covered period, the 8 weeks or the 24 weeks. Keep in mind for that number, if somebody works 40 hours a week, that's 1. Somebody works 20 hours a week, they're a 0.5 full-time equivalent. Somebody works 30 hours a week, they're 0.75 equivalent. Divide the average number of FTE employees during the covered period divided by, and you get to choose which period you're comparing to. You'll either look at your average full-time equivalent employees from February 15th, 2019 to June 30th, 2019, or you'll look at the average full-time equivalent employees per month for the first 2 months of 2020. So again, if your practice had more employees in 2019, you had a couple quit, you didn't replace them, so your employee count was down the first 2 months of 2020, you're going to want to use the first 2 months of 2020 as your comparison period. Okay, the forgiveness applications also literally just changed, a week ago. They've now come out with an easy forgiveness application. It is pretty simple, pretty straightforward. If you meet any one of these three items, you will be eligible to use the easy application. So if you are self-employed or an independent contractor or a sole proprietor with no employees, you can use the easy form to apply for forgiveness. If you did not have a greater than 25% wage reduction for any employee that makes less than $100,000 during the covered period. Now, again, this is a little confusing because on the easy application, they're going to say during the covered period as compared to the first 3 months of 2020. So if you didn't have anybody whose wages dropped by more than 25%, and you didn't have any decrease in the number of hours or the head count of full-time equivalent employees from January 1st, 2020 to the end of your covered period, then you can file that easy forgiveness application. So essentially, if you feel confident that you didn't reduce employee headcount, you didn't reduce salaries, then you're going to be able to file the easy application. If you did, and so you have some sort of reduction in forgiveness factor, you're going to file the long form of the forgiveness application. The other way you can file the easy is if you didn't have that greater than 25% wage reduction for your employees making less than $100,000, and you were unable to operate at the same level as before COVID due to, shutdowns, due to CDC guidelines, due to Secretary of Health guidelines. So in essence, you didn't reduce anybody's wages by greater than 25%, but you might have had, not been able to rehire all of your employees or not been able to keep everybody because you were still shut down, then you're going to be able to use that easy application as well when you're applying for forgiveness. There were a couple of other just miscellaneous provisions in the CARES Act that I wanted to touch on because I'm guessing many of you are going to be able to take advantage of these. There are some employer FICA tax credits. Now, when the PPP loans first came out, the CARES Act had said, if you're going to apply for some of these FICA tax credits, so Social Security tax credits as an employer because you're paying sick leave or family leave to an employee who is affected by COVID, or if you're taking the employee retention credit, that's for employers whose revenues drop by greater than 50%. They said, if you're taking those, you can't count that same payroll that you're applying for FICA tax credits in with the payroll that you're using as a forgivable cost in the PPP loan. Well, the PPP Flexibility Act has said, no, that's not true. You actually can take advantage of both. So that's going to be important for you to talk to your CPA about, talk to your payroll service about those and make sure you're getting those FICA tax credits. There are also some deferrals of employer FICA taxes where you can defer them out till next year. So be looking at that, understand those. Again, talk to your CPA about that and make sure you're got the calculations and you're getting the credits that you're eligible for. There was another loan that came out at the same time, and these loans had been around previously with the SBA, but they're called economic injury disaster loans. And many of you might also have gotten an EIDL loan in addition to the PPP loan. The EIDL loans, you're allowed to use the proceeds for more costs than just, payroll, mortgage, interest, rent, and utilities. You could use it, for instance, for, you owe your vendors for supplies and you were shut down, so you didn't get any revenue and you still have a bill for your supplies. If you got one of the emergency advances under the EIDL loans, those were available of up to $10,000. You were supposed to get them within 3 days of making the application. they will back that emergency advance amount out of your PPP forgiveness amount. So just know that. There's a lot of calculations going on all over the place. I hope you guys are talking to your CPAs and getting the updates on these. I do want to touch for a minute on the coverage periods, okay? So 8 weeks or 24-week coverage period. On the surface, it might seem, why would I not choose the 24-week period, right? Then I've got 24 weeks of my employees' payroll that I can count. I've got 24 weeks of rent, mortgage interest, utilities. Probably if you choose a 24-week period, if you didn't have those wage reductions or headcount reductions, you're probably going to be able to get the full amount of forgiveness, right? The caution on the 24 weeks is obviously we're seeing a resurgence right now. Some states are starting to shut some businesses down again or limit things again. So if you choose that 24-week period and you do end up having a reduction in employees and you can't hire them back by December 31st, then you would still have some reduction in your forgiveness. So just keep that in mind. We've really been telling clients, if you're getting all the costs paid out in that 8-week period, you might just want to use the 8-week coverage period and kind of be done with it. Apply for forgiveness, get it. Also know the forgiveness is only for the principal. You will still have to pay that 1% interest, even if the full amount of the principal is forgiven. That's it in a nutshell. However, one more word of caution. As I mentioned, the guidance is ever changing. I just read an article today. SBA's, got some lawsuits now on their handling of the PPP, or because entities are saying that their guidance did not really follow what the law said. So just be on the lookout for additional guidance. Use your CPA, use your professional advisors to make sure you've got the most up-to-date information.
Carole, thank you. Great presentation. Billy, can we take the deck off the screen? There we go. Great. So I know it was a great presentation because we got a lot of questions. So it was pretty thought-provoking. We're not going to get through them all, I don't think, but don't fear. If we don't get through the ones that we don't get through, Carole has graciously offered to answer them offline. We've saved them all. Another thing, one of our participants at least asked for Carole's PowerPoint deck. So if you look in the handout section, I think it's still there. There's up in the Q&A section, there's in the navigation bar, there's a item that says handouts. If you click on that, the PDF should be there. I'm not seeing it this minute, but maybe because I clicked on it earlier. In any event, I think it's there. If not, simply email us and we'll get you a deck, no problem. But I think it's there. Okay. So before we get to Q&A, and that's what we're going to do right after this, I want to talk about something that I think is particularly appropriate given the current context. And the current context gave rise to Carole's talk, which is all about the PPP. Why does the PPP exist? Of course, because of COVID and the fact that so many of us, including medical professionals, had to completely shut down or nearly that their practice or business. We sadly are one of those, and we actually got PPP funding. American Educational Institute did. So the lesson there, of course, the harsh lesson is in these times, we are not in control of our revenue the way we're used to being in control of our revenue. We can't really impact it, and we can't impact its eradication. In some cases, complete cessation. Now I know we're all climbing back, but it's not what it was. So to add insult to injury, the cost of reopening our businesses and our practices is actually now more expensive because of COVID, because we have to make them COVID safe. So we're reducing revenue, we're increasing expenses. That lends a greater imperative to trying at least to manage our cost structure, manage the part of our income statement that we can have some impact over. And that is reviewing our cost structure. So we have, as you all know, you've been taking our courses for a while, most of you. we have been teaching practice management strategies for literally decades now. So we were racking our brains a couple months ago about what can we do? What can we really offer our registrants, our clientele, that will help them actually reduce expenses? And we hit upon what I think is the most frequent expense that any practice incurs. That's your credit card merchant fee. So every time a patient pays you for your services by credit card, I'm sure you know this, you pay a slice of that to the credit card processor. It can be about 3%, as high as 3%. It doesn't sound like a lot when you express it that way, but if you do the math, you know how much you receive annually in credit card fee payment. Take 3% of that. It's a lot of money, actually. So we have established a relationship, partnership really, with a large national credit card processor that happens to be located in the Detroit area, which is where we're located. And among the businesses they specialize in are professional practices, medical practices in particular. So that gives us the ability to offer you the best rates in the industry in terms of credit card rates. We have found that we're able to save those folks that have expressed an interest in this thousands of dollars a year. In fact, I see there's a question from a physician who I know, who I think is about to onboard with us with the credit card processing, and we're going to save him, I believe it's $7,000 a year. And so if that's of interest to you, if it's not, no problem. If it is, simply type your cell phone number into the question box. We've been typing the questions, hit send. We will know who it's coming from. My colleague, Billy Allen, who is our payment specialist, will be in touch within 24 hours. And shortly thereafter, he can give you a pretty solid feel of what you can save. And if it works for you, great. If it doesn't, that's fine too. So let me ask the question. We'll start Q&A now. Let me ask the question of the doctor who I believe is going to be using these credit card services. His question is, our definition of FTE, full-time employee, is 36 hours. Do we have to use 40 hours?
That's a great question. They come out in the guidance and said 40 hours. There's actually a lot of talk previously that they thought they would use 30 hours. 30 hours, what's considered FTE, I think under the Affordable Care Act. They've said 40. So my guess is yes, for all of your, and that's okay for all of your 36-hour employees, right? 36 divided by 40 would be the percentage of your full-time equivalent. As long as that wasn't reduced, that would be your count.
Good.
So.
Okay, here's another one. I'm going to go now in order that they're received, and we'll get through as many as we can get through. It's a lot. Okay, here's a question from one of our participants. I had an employee quit during the PPP period. Now she wants her job back. If I hire her back, how does that change my forgiveness calculations?
So again, as long as you hire her back and she's back on by December 31st, you can essentially ignore the weeks that she wasn't working during the coverage period. So I think your problem, you still could have a problem, if your payroll doesn't meet the 60% guideline or something like that. But for a head count, that'll be fine.
Great. This one's quick. I think I know the answer, but I'm not going to venture a guess. Does payroll, these payroll taxes count as allowable expenses for forgiveness?
So payroll taxes, only state and local payroll taxes paid by the employer. Okay, so not employer Social Security or Medicare taxes; those don't count. But any employer, state, and local taxes. So if your locality, some localities have an employer payroll tax, you're paying that. That would be includable. Like I said, state unemployment and workers' comp would be includable.
Good. Okay. There's another one. I'm going rapid fire because we have so many. So is the documentation for forgiveness standardized by the SBA, the Small Business Association or agency, or specific to my lenders? The documentation for forgiveness standardized by the SBA, or is it specific to a particular lender?
So lenders are allowed to sort of take the SBA applications and make them their own. I think what you're going to see is it will be the SBA's application. Your bank might make it, an electronic version so you can go online and complete it. Your bank will probably include with it what documentation they want, as far as payroll tax reports and invoices and things like that. But they are required. SBA gave them the latitude to kind of, put it on their forms, but the information will need to be the same.
Okay. Here's one about the 8 versus 24 weeks. If it takes more than 8 weeks to use the funds, but less than 24, can I apply for forgiveness sooner than the expiration of the 24-week period?
So they just came out and said that you can apply before the 24 weeks is up. What is not yet clear that I haven't seen is how's that going to affect, obviously the 24-week period is not up in terms of your head count and those types of things. But I just saw an article today the AICPA put out about that they are saying you can apply before the end of the 24 weeks. So.
Okay. So if you have a spouse who is an employee of the practice, is the spouse of the owner considered an owner or simply an employee like all others?
I believe the spouse will be considered just an employee. They have really not come out and stated a lot on, what we in the tax world call the attribution rules. So presumably if that spouse, let's say it's an S Corp, the spouse is not an owner, doesn't get a K-1, then the spouse would be limited to that $100,000 annualized limit, but you could include retirement benefits and health insurance for the spouse. Again, you're going to want to make sure that the spouse, the health insurance was being paid for the spouse previously and not just for yourself.
Right.
You're going to have some documentation.
So here's a physician who received the loan 6 weeks before his office reopened. So he wants to know, how does he choose the 24-week payroll cost?
So if your payroll is greater than biweekly or more often than biweekly, then you can choose that alternate payroll period, but it still has to start the next payroll date after you receive the loan. So, let's, as an example, if you received the loan on April 15th and you weren't allowed to reopen till June 1st, your period still starts beginning April 15th.
Okay. Here's a long one, so I'm going to read it to you, as I've been doing. If you do not spend all of your loan on wages and rent and utilities, but you follow the 60-40 rule, is the entire loan forgiven or only the amount actually spent? If not forgiven, will the amount actually spent be forgiven? And then you could immediately repay the non-forgiven amount and not have an interest expense.
Right. So if you, it's a little bit complicated.
Right.
You won't have it all. If you don't spend it all on those allowable costs, it's not all going to be forgiven. So if I got a $100,000 loan, only $90,000 was spent on all of those eligible costs, I'm going to have to repay $10,000 of principal. Okay.
Yeah.
That 60-40 calculation could still come in. You will still have to pay interest on that. Interest begins being charged on the day you receive the loan, just like any bank loan. So again, if I got my loan on May 1st, the clock starts ticking on the interest on May 1st.
Okay, thanks. A little shorter one here. Is a 20% shareholder of a C Corp treated as owner employee or non-owner employee?
I think they will be treated as an owner employee.
Yeah, sounds right to me. Okay, when determining how many employees we have to ensure we have not reduced number of employees, can we include S Corp employee owners, employee/owners?
Yes, but keep in mind you're going to include those for the previous period that you're comparing against and the coverage period. So you'll include them both, the numerator and the denominator.
Okay. Here's one about an employee that chose not to return to work, and I think that's more common than people would like,
Right.
and for various reasons. But if one of my employees informed me they did not want to return to work, then I hired a replacement employee for that position at a higher hourly rate and the same full-time hours, will that not affect my forgiveness? Will it affect my forgiveness?
That will not affect your forgiveness because you don't have to have the same employees, just the same head count. So you're fine in that situation.
Okay. Here's one about health insurance and pension. So can you clarify how the health insurance cost and pension fits into the owner and non-owner employee total? Is it considered part of the total you showed for the non-owner employee? Is it not allowed for an owner employee?
So the non-owner employee amounts that I showed are for their cash compensation. So either that 15,385 or the 46,000 and change if you use the 24-week period. That's cash compensation. You can add to that health insurance costs the company pays and retirement benefits the company pays for the non-owner employees. For the owner employees, you're limited to a maximum of either 15,385 in total. Doesn't matter how you pay those, cash, benefits, whatever. 15,385 in total, or 20,833. So you're not even getting the full 24 weeks for your owner employees.
You may have already answered this. It's a different question, but you may have already answered it, but I'm going to ask it anyhow.
Okay.
If my payroll was received on May 5th of this year,
Mm-hmm.
payroll on May 15th, can I include employees' work hours and wages on May 1 and May 3?
Yes. So because you paid that payroll on May 15th, it was paid during the coverage period because your coverage period would have started on May 5th. So yes, your full payroll that you paid out on May 15th would be included as an allowable cost.
Got it. Okay, we'll do about another 10 minutes here, and then we'll be at our hour mark. But we're good. We're doing pretty good. We're getting through this.
Good.
Homework for you, Carole.
Yeah, exactly.
Okay. So here's one. Should a sole proprietor do the 24-week option? Is that a default?
The sole proprietor will want to do the 24-week option. The sole proprietor, if you don't have employees, you're going to want to use a 24-week period because that's what's going to get you that $20,833 max. If you don't use a 24-week period, you're limited to 15,385. So yes, I think typically you're not reducing headcount if you're the sole proprietor and no employees. So you would want to use 24 weeks.
Here's an interesting question. I want to point out to our listeners, Carole is going to be part of our next year's, the 2021 course. She's going to be giving a presentation on financial statements, in other words, income statements, balance sheets, cash flow statements, and proper management interpretation of them. I just thought I'd flag that. So this is not the last you'll see of Carole. Okay, this is an interesting one. Would a surge resulting in additional uncompensated work hours satisfy the good faith certification in lieu of reduced revenue?
A surge resulting in
uncompensated work hours.
So yes, I mean, any of those kinds of things, any way that kind of your business was negatively impacted due to COVID in terms of good faith certification, just make some notes on it, keep it in a file.
Right. Here's another one I think I know the answer to. I'm not going to answer it though. The question is, if the loan is completely forgiven, is the interest also forgiven? I think the answer is yes, but no.
Interest will have to be paid regardless. 1% interest.
Oh, really?
So again, if you got a $100,000 loan, I mean, again, it's 1% for the year, right? So $100,000 loan, 1 year's interest would be $1,000. It's going to be something less than that, assuming you are forgiven. Let's say you're forgiven within 6 months, so you're going to cut a check for $500 for interest.
Interesting. Okay, this is why I don't answer the question. Okay, here's another one. Can you comment on the $50 billion paid out for the Medicare Provider Relief Fund and how it might impact whether we certify for it or return it?
I cannot really comment on that because that is not really I have not done a lot of studying up on that Medicare Provider Relief Fund. So I'm going to decline to comment on that one.
Okay, fair enough. Where do I go to fill out the EZ application?
So you can actually download it on the SBA's website, sba.gov. The application and the instructions for it are on there.
Okay. Let's see. When can I apply for the forgiveness? I've already complied with the required payments to be eligible for full forgiveness.
So I have heard that some people have tried and have had their banks say we're not accepting them yet. You know, when it originally came out, the CARES Act originally came out, they had said the coverage period would run through June 30th. So my guess is soon the banks will be ready to start taking the forgiveness applications. Some of them might already be. I would reach out to the banker that you worked with to get the loan and ask when they're going to start taking those applications.
Okay. Oh, here's somebody that's noting that they want to get in touch with you, but your contact info disappeared. I'll tell you what we'll do. We will send, I'm speaking as if I know we can do this, but I'm sure we'll figure it out. We will send everybody on this call Carole's contact info so you have it. So sorry about that. If an employee is fired in the coverage period but replaced immediately, keeping the same head count, is that okay?
Yes.
Okay. All right. We may get through this. Oops. Okay. Is the allowable compensation for an owner sole proprietor, based on 2.5 months of 2019 Schedule C or 8 weeks of compensation if you take the 8-week covered period?
Yes and yes. So if you are a sole proprietor, you're going to look at your 2019 Schedule C, and the maximum you have to look at, as a sole proprietor, you're looking at the lesser of two numbers, okay? It's the lesser of, if you're choosing 8-week period, 15,385, or your 2019 net income from your Schedule C divided by 52 times 8. Or if you choose a 24-week period, it's the lesser of $20,833 or your 2019 Schedule C divided by 12 times 2.5. And again, limited to, right, the most you can take from that Schedule C for 2019 is 100,000. So if your Schedule C net income is above 100,000, you're going to knock it down to 100,000, divide by 52, multiply it by 8. That's where you get the 15,385 or the 2833.
Okay, here's my favorite question. This is excellent. Will I be able to watch this again? I think the answer is yes. We're going to post this. This is being recorded. And I think in that same email that we'll send Carole's information, we'll send you instructions as to how to watch this video. We'll probably send out an email to our whole clientele base to give them the opportunity to see this if they couldn't watch with us today. Let's see. Since the covered weeks were increased to 24, does that mean the forgivable salaries increased to a prorated 100,000 for each of the weeks instead of 8 weeks?
Yes. So if you're using the 24-week period for your employees who aren't owners, that the maximum for them is that it's $46,000, I think $251. It's 24 weeks over 52 times 100,000.
Okay. And I think I know the answer to this one from personal experience, but I'm not going to venture a guess. Do 1099 employees count in the head count, and do they count for forgiveness?
No. They had to request their own loan, and they count in their own head count, not in yours.
All right. So you answered 2 questions with that one. Well, I can't read this one fast enough to know if I should ask it, so I'm just going to ask it. If I had one full-time employee and one part-time employee who worked sporadically prior to COVID, less than 20 hours over 3 months, and post-COVID post-COVID you only have the one full-time employee, how many FTE would you say that is now?
So now, if you only have the one full-time employee, you probably just have one FTE employee, right? 40 hours a week. Right. Previously, you probably had, if they were less than 20, maybe you had a 1.3 or 1.4, depending on how many hours they worked.
We have 3 employees who are not rehired because the state has not cleared them to work. They're estheticians.
Okay.
In California. This gentleman's from California. Will that qualify as the exemption, unable to operate at same level as before due to guidelines?
Yes, that should count for sure.
Okay, cool. This participant received her PPP on May 1. I think you may have answered this earlier with another gentleman, but my payroll for April 26th through 9th was paid on May 15th. will the whole payroll be forgiven, I think.
Yes. Yes.
I think we're going to do this, folks. I think we're getting through all of them just in time. All right. This participant was in the second round, independent contractor. I was never offered longer than 8 weeks. Is that right? Did you understand the question? Because I'm not sure if I do.
Never offered more than 8 weeks for the amount of the loan. Is that?
I don't know. I will read it verbatim. I was in second round dash independent contractor.
Okay.
They mean to say, and I was never offered longer than the 8 weeks. Is that proper? Is that correct?
That might have been, again, the banks didn't have good information. So some of the banks were giving bad information when the loans were being made. There was a lot, different banks were saying, oh, yes, include partners if you're a partnership. No, don't include partners if you're a partnership. There just wasn't clear guidance. So it's very possible you did not get the full amount of the loan you're eligible for because the guidance changed or the guidance wasn't clear at the time.
Okay. Here's a quick one. When does the interest clock stop running?
The interest clock stops running once the amount is repaid, or if it is all forgiven, then it stops running once I believe it will be once the forgiveness application is processed. So if you've got the costs all spent and you want to apply earlier, that's going to stop that interest clock sooner.
Yeah, right. Here's one asking for clarification. He confesses confusion, and if he's confused, I suspect others are. Here it is. Sorry, I'm confused about the 8 weeks versus the 24 weeks period. Do I have to contact my lender to declare my 24 versus 8 week period?
You don't have to contact your lender. They're going to ask you on the application. It's asking you what period you're choosing, 8 weeks or 24 weeks. So you'll put that on the application. Again, I would highly encourage, and I can't say this enough, I'm a CPA, so of course I'm biased on, utilize your CPAs. But definitely, I would encourage you to talk to your CPA about it, kind of run through the calculations with them if you're not having them do it for you, just to make sure you're making the best move for your practice.
Right. This is a good one. If my expenses became greater than that which they initially applied for, the PPP Loan app, can I get more of a PPP loan, a triple P loan?
No, the PPP applications close actually on Tuesday, June 30th. So, and once you've gotten one, you cannot apply for a second one.
Okay, I'm not going to read you all the thank yous here I'm seeing and your very positive reaction, but this has been really interesting. That's all the questions. So we're down to the last couple. We're going to finish right on time. It's perfect. Are there any changes to deducting expenses paid with the forgivable portion of the PPP loan?
Any changes? Not really. None of that has really changed. The only thing that has changed in the guidance is kind of those calculations for owner employees. Nothing has really changed in terms of the non-payroll costs.
Right. Got it. Last one. And we're going to finish right on time, 8:30. Can I apply? Well, they keep coming in, so now I can't see it. Apply. They're actually mostly just thank you. Thanks, Carol. Thank you. This has been really well received. Can I apply for more than one PPP loan if I own several different businesses?
Yes, you can. You can apply. Each business presumably can apply for one. So,
well,
yeah.
Wow, this will never happen again. It's 8:30, and we've asked all the questions as of that last one. So, here's one more. We'll get it. If I choose 24 weeks, can I get forgiveness for greater than 8 weeks for owner's salary capped at $100,000?
If you choose 24 weeks, the maximum for the owner's salary is going to be $20,833, assuming you paid yourself more than $100,000 or at least $100,000 in 2019.
Right. Well, we're done. Carole, that was phenomenal. It was really great. Action-packed, tons of great information. I thank you very much. I thank you on behalf of a lot of participants this time all stuck with us. So I'm thanking you, I think, on their behalf as well. And to all of our participants, as promised, we're going to send you the following: an email with a way to watch the recording of this presentation, should you want to see it again, as well as Carole's PowerPoint deck. So thanks all for tuning in.
Hey, David, just quickly, We do also have some resources on COVID and PPP on our website. If they want to go to that, it's just www.ojmgroup.com. You might see some older videos from earlier guidance, so just be aware of that. But there's some information that you might find useful.
Great, and tell the folks how to request the whichever the books they'd like.
The book, right? The book is on. You can go to that same website, ojmgroup.com. Go to the bookstore. The code for a free book for you guys is AEI OJM, or you can also text that code to 555-888. So you can do that tonight. You'll get a reply probably in the morning. Send your contact information back, and we'll get you a book.
Perfect. Carole, thank you. Really
thank you, David.
And thank all of you for watching. Enjoy the rest of your Sunday evening, and we'll do this again. So watch your inbox. Good night, all.
Thanks, David.
Thank you.